Hey, what's going on everyone, and welcome to episode number 27 of this educational video series. I'm your host Vijay and I'm a CPA. If you recall, over the past three videos, we kind of took and we looked at overview of three of the most popular entity structures among small businesses: the sole proprietorship, an LLC, and an S-Corp. And at the end of last video, I also mentioned that S-Corp structure saves a considerable amount of money in taxation over an LLC or a proprietorship. And in this video, I wanted to kind of cover an example and show you how that's possible. And again, wanted to drive home a point that if you are operating an LLC, if you're operating your business out of an LLC or a sole proprietorship, and if you meet the eligibility for an S-Corp and it makes sense, then you should definitely convert to an S-Corp, or at least make an election such that your business will be taxed as an S-Corporation. So let's dive into it. Now let's make some assumption for the simplicity purposes. If you know this assumptions, any change in this ownership or income or tax brackets, etc., will not affect the end result. These assumptions are simply just for the simplicity's sake for this example. So let's assume that the taxpayer or the person that owns the business is the single owner or shareholder of the business, and business will be taxed, or business income rather, will be taxed at a 25% tax rate. Let's also assume that the business had a taxable income of $50,000 for a given tax year. Now for S-Corp, if you recall, the IRS requires that the officers of S-Corporation or the owner officers of the S-Corporation must take a reasonable compensation for the services they provide to the corporation. So for the S-Corp, let's assume that the taxpayer took a reasonable compensation of $25,000 for the year, and after taking into consideration the $25,000 compensation to the officer, the business income for the S-Corp will be reduced to $25,000 now, because S-Corp gets to deduct the officer's compensation deduction when computing the taxable income for the business. Even in this case, though, the total income to the taxpayer that will flow through the taxpayer's tax return will be the same $50,000, coming from $25,000 of salary and wages and $25,000 of income that is passed through to the S-Corp owner. So under all three scenarios, the total income passed through to the owner or the shareholder of the business is the same. It's just $50,000. Let's also assume that the income earned by this business is subject to the self-employment tax, and some income, for example, if the business earns income by investing in real estate, that's usually not considered a active business or active income. So that income is not subject to the self-employment tax, but everything else, like a plumber or accountant or a doctor or any of those kind of businesses income will be considered subject to the self-employment tax. So for this example also, let's assume that the taxpayer's business income is subject to the self-employment tax. Now let's see how the taxpayer will end up paying tax on this $50,000 business income under all three different entity structures. So as you can see in this table, the business income received under sole proprietorship is $50,000, under LLC is $50,000, and under S-Corp is $25,000. Remember, the officer took the owner took a $25,000 salary under the S-Corp scenario. So the total income after considering the $25,000 of wages, as you can see on line 3, total pass-through taxable income that will be reported on the individual taxpayer's tax return is $50,000 under all three scenarios. Now, we assumed that the business income will be taxed at a 25% tax rate. So as you can see, the federal tax at 25% rate under all three scenarios will be $12,500. So as you can see, there is no change in the amount of federal income tax that's applicable under all three business structures. But what makes a difference is the self-employment tax. Now, if you recall from past videos, any and all income earned by a sole proprietor or an LLC owner is subject to the self-employment tax. The business owner is considered employee as well as employer for the purpose of computing the self-employment tax under these two scenarios. And that person will be taxed at 15.3% for the self-employment taxes. These are, your Social Security and Medicare taxes. So as you can see, at 15.3%, the self-employment tax under sole proprietorship and an LLC will be $7,650, which is 15.3% of the total business income of $50,000. Now under S-Corp, only the salary that's taken by the owner is subject to the self-employment tax. So in our example, the owner took $25,000 of salary out of total $50,000 business income. So only that $25,000 of salary is subject to the self-employment tax. So at 15.3% self-employment tax, the owner will pay the self-employment tax of $3,825. He or she will save the self-employment taxes on the remaining $25,000 that's of business income that's left after taking the salary from the business. So as you can see, the total tax paid by this individual is $20,150 under sole proprietorship and LLC, and the tax is $16,325 under the S-Corp. So as you can see, there's a significant difference. In this example, the taxpayer saved $3,825 by saving the self-employment tax on the portion of the S-Corp income that's left after taking the salary. The portion that's left after taking into consideration the salary, that amount is distributed to the taxpayer tax-free. It's a tax-free distribution. So in our example, $25,000 that's left after paying the salary is distributed to the taxpayer tax-free. So as you can see, it's a significant savings. Now this business only earned $50,000. If the business earned $100,000, then you can see the saving would literally double. And if the business earned $1 million, then you can just calculate how much saving this taxpayer will have after just because he had an S-Corp or she had an S-Corp rather than a sole proprietorship on an LLC. So again, operating your business under an S corporation has the potential to save you thousands of dollars in taxation per year. So if your business qualifies, then you should certainly consider switching to an S corporation. There is a form that you had to fill out if you're an LLC. There's a form that you have to fill out. It's called the IRS Form 2553, and that enables your business to be taxed as an S-Corp. So in that scenario, if you're an LLC, if you complete the Form 2553, then your business still remains an LLC on paper, but as far as the taxation is concerned for the IRS, your business will be taxed as an S-Corp. Now, if you're just sole proprietorship, if you're operating a sole proprietorship, then you should simply consider incorporating your business, and once you incorporate, you have to fill out the form 2553 with the IRS to make a subchapter S election. So significant savings under S-Corp compared to the other two entity structures, and you should definitely consider switching to an S-Corp if your business qualifies. Hope that makes sense to you all. If you have any questions about this video or any other videos that I created or any other tax or accounting related issues, feel free to reach out to me. I'll be more than happy to answer any questions you may have. Last thing before I sign off, if you like this video, please don't forget to hit that like button, share it with your friends and colleagues, and subscribe to my YouTube channel. That's it for this week, everyone. Take care. I'll catch you all next time. Bye-bye.